right. We are back with yet another episode of Exit Liquidity. And today, as usual, we have Captain Rational on deck and Jedi Blockmates bringing the house. But what are we going to talk about today, gents?
Well, it was the
Today
FOMC day.
is, I was just going to say, today is the 3rd of May. The FOMC is meeting today as to whether or not they want to stick it to the banks some more and raise rates another quarter point. Congress is pleading no. The White House is pleading no. Jay Powell may or may not care.
That's crazy to see the politicians express such opinion. Historically, where's this? There's no separation. There's no, you know what I mean?
Yeah, it's not unusual though. I mean, even back in the day, like Nixon, I think was, yelling at, was it Volcker at the time? Like it's not unusual. There have been presidents that have physically threatened their Federal Reserve chairman. So like it's not entirely unprecedented. I mean, Trump too, he was, complaining about Jay Powell and he almost lost his job because he wasn't keeping rates low enough to make Trump happy. But I don't know. It's going to be interesting. Like there is a lot of hidden weakness going on right now in the banking system. Some of it not so hidden, but like the whole First Republic thing, like I'm pretty sure that First Republic was functionally dead the same time that SVB was. But the problem is, I think that interfered with the political narrative that, oh, this is an isolated incident. Like this was just a badly managed bank. And so they contrived this whole rescue operation where all these other banks like JP Morgan and PNC, they all put in some deposits into FRC FRB, and they basically kept it alive for another month in order to let that whole everything's better now sort of play out. And here we are a month later and it's dead.
I hate the narrative that's circulating that these banks were badly managed. You could have the individual conversation about their loan practice, but with regard to allocation of deposits to U.S. government securities, that's by definition exactly what they're supposed to do. So that's just awkward.
Yeah, like the whole thing, and I think Captain, you and I talked about this on one of your Twitter streams, but like, don't let the Fed get away with this narrative that this is somehow the bank's fault, because what happened was during COVID, you had this event, this exogenous event where everybody wanted to run to safety all at once. And at the same time, you had the governments all wanting to spend a bunch of money in order to help people through this pandemic and all of the externalities that came with it. And so what happened was these governments wanted to spend a whole bunch of money, but they didn't want it to hurt the bond market when they did it. And so they worked together with the Fed. The Fed acted as a giant vacuum cleaner, sucking up all these treasuries to keep them off the market and buying them at pico top prices, because treasuries trade inverse to the yield. So if the yield is down at 0.25% where they had it, it doesn't get any lower than that really, unless you're in European treasuries back in like the late 2010s. But like, so they basically had the government issue all this money via stimmies and all this other stuff that made its way into deposits into these banks. So all these banks get all these deposits, and the interest rates that they're able to invest these things at are like at the absolute bottom of the barrel. The prices are at the moon, and they force these banks to invest in this shit at the pico top. They had no say in it. If they had actually stayed out of it, if they had just let the market do what it was going to do, realize that, hey, right now everybody is dashing for safe assets. We should let the prices go where they may so that the free market can actually balance out, and it can actually reward people that buy this stuff in the public sector, rather than trying to force the government body that is the Fed to just suck all that price action away so that we'll deal with it later. Well, we're dealing with it later now, because now, after making the banks buy all this shit at the absolute pico top and then forcing them to take the L the entire way up, they're like, you guys manage this poorly. Fuck you. Like, you did this to me. Like, I don't see what, I don't understand why the banks are not like calling this shit out. I really don't.
Public. Yeah.
Yeah.
Well, it's because they'll get freaking body bagged, bro, and thrown at the bottom of the river with a slab of concrete. That's
true story. True story. Or at least figuratively, the FDIC will come for them and be like, we don't like the way you're managing your bank. You have entered into receivership. And
maybe even the FCC for communications violations or something.
Yeah. I mean, there could be any number of ways that the government can make their lives hard for them if they don't play nice here. But like, seriously, the Fed put them into, like, the banks into this position, because when Janet was issuing those, like, that $5 trillion deficit or whatever we ran, like, if we had done that and just let treasury prices go where they may, A, we would never have had inflation. B, we would not be in the situation where our banking system is fucked. Instead, the banks would have gotten like crazy amounts of net interest margin that they could have like improved their operating margins, and like we would have had a super healthy banking system. But instead, we're now doing this thing where we held the interest rates super low, and then now we're cranking them up via the RRP, which actually just forces all the deposits overseas, which is the exact opposite of what they want. They're trying to like reel in this shadow money system, and they're doing the exact opposite of what they should be doing, which is they're pushing all the domestic money out of the US, and then they are incentivizing it to go there by giving money market funds the RRP rate, which is trading below or way above, as far as like offering yields way above what you can get on a 1 month treasury. And that's an overnight rate. It's just baffling how they don't understand the system in which they operate.
2020 invalidated the historic, I would argue, the historic scenario for the end of the cycle, where the US government has a capacity to force the rest of the world to sterilize issuance, meaning they got to raise the capital, the bond market goes vertical to the upside. You think you can have a lower low after 2020? How does the technicals look on any of the bonds? It breached the 41-year trend line to the upside. Structurally, the system is not going back. With the BRICS announcement, I mean, yeah, I align in good part with what Brent Johnson talks about, and the humor of global debt servicing obligations dollar denominated. But with what's going on internationally, the narrative, they're done. People, sovereigns, countries, they're done with this game of the US forcing the rest of the world to sterilize their issuance.
So I don't know if I necessarily agree with that. I think I sort of fall into the Michael Pettis camp a bit, which is like, his stance is more that like these surplus nations, like the Germanys, the Chinas of the world, that run these just perpetual surpluses because they refuse to let demand actually grow internally, because you have this politically, connected few that all the profits sort of go into, and then they just use that money to invest overseas and recycle it elsewhere. Because the only alternative to that is to allow that some of that money to stay in the country and actually go to people. And so the choice for China is like, you either spend that money in China, or you have to go buy dollar denominated assets outside China or outside Germany. And if you aren't willing to do that, then you're still going to have this draw towards investing in dollar denominated assets. That's going to pull, like, because that's where the deficit comes from. The reason we are able to even run a deficit without massive like yield curve control on the Fed side, which they have had to do that during these like
World War II
exogenous shocks, but we're not like at Japan levels where it's just an everyday occurrence that we just live with. I mean, during like the periods of, somewhat normal times, the Fed really isn't doing a whole lot of buying treasuries. They're just kind of standing pat as far as like how much, because the Fed balance sheet tends to do this thing where it goes up and then flat, and then something bad happens and then it goes up. And then, so like during those flat periods, there's nothing that's like the Fed is doing to ensure that we're able to run these massive deficits. It's all happening completely organically because these other countries refuse to like, they either toy with their currencies in order to make sure that they're competitive, and they also keep their standards of living down in order to make sure that they're competitive. And they do that by making sure that the money, rather than matriculating to their own people and spurring domestic demand, they just ship it overseas and invest in dollar denominated assets elsewhere. And so I don't know that like, I don't know that I buy the whole story yet, that like we've really had any sort of like true decoupling with these countries. I think that a lot of that whole narrative, the de-dollarization narrative, really just comes from people observing the symptoms and assuming that they are coming from a place of this is what they want to do, rather than they're currently forced to do this because they don't have enough dollars to meet their dollar denominated debts. And I think that also with China, you're seeing a lot of obfuscation. Like there's been so much news lately of like China kicking out all of the auditors for all the like big four financial firms from their country. China locking down all their economic data even further than they already were. They've been introducing even greater capital controls than they were before. These are not the qualities of a entity that's ready to take the reserve currency status, because who the hell is going to, like, of their own volition, choose to use a currency where they're using all this sort of obfuscation and like putting their currency basically in a black box, and not to mention all the weird shenanigans that are pulled between, HSBC, like in, Hong Kong's dollar. Like, I don't know what they're doing with Hong Kong's dollar with regard to China, because like you have the yuan and the Hong Kong dollar, and both of them are really kind of in the same, power structure at this point. And so I almost wonder if they're not trying to blow up the Hong Kong dollar so that they can consolidate it all under the yuan.
They probably want to. Hong Kong has always been outside to a degree, obviously, with the British history and all. So they've operated unto themselves to a great extent, a little city within a sovereign. So obviously mainland wants to consolidate, and so when you consolidate, you have a better capacity to organize. I just one more point about de-dollarization. It's not, there's no instantaneous switch. Obviously, reserves have changed structure globally over the last years. It's about the margins. Change starts at the margin. So, and directionality is what I like to observe. It's like weight, a person's weight. You're either getting heavier or you're getting lighter. There's no such thing as you're the same weight. So it's the same thing with trends. Something's getting stronger, something's getting weaker. So reserves are being held less in dollars. The dollar denominated debt ensures that everything you say is actually the case. It's overwhelmingly the case. And European nations are still wanting to consume these US government securities, and that's fine. They finance our fiscal desires. But structurally, the trend is that their productivity is going to go down, energy complexities and whatnot. And structurally, countries don't want this direction, the historic directionality of what we had the last 41 years. The bond market indicates that structurally. So that sterilization capacity that the rest of the world has historically offered should continue to decrease over time. And this plays into what Raul talks about, how what the Fed is going to end up having to do. The Fed has to accommodate the difference between fiscal and GDP. They have to print the difference. So that alone is going to support the trend, because as they finance the difference, there's the Fed balance sheet at 12, 14 trillion, whatever number, whatever spread he's been recently talking about. And you have your 97% correlation between central bank balance sheets and asset prices. So as these numbers continue to go, that's the trend. The trend will continue also for the de-dollarization narrative, and the other trends that are in play. They're going to continue. Trends don't just stop. They don't just stop and reverse. They continue until capitulation. So this is the directionality, and it's just going to continue.
Yeah. I mean, so I think that I largely agree with all of that. I mean, I think that the Fed doesn't really have an option going forward as to how to proceed in all of this, because they either let the system burn, or they
can't do that.
or they transition to something else. And
There's
if they transition to and if they try to transition to something else, I'm not sure that takes. I am not sure that if they introduced a CBDC or something like that, I'm not sure.
Introduced.
Yeah, well, that's the thing. You have no Lindy. Your Lindy is gone. If you try to change the monetary system, and that's ultimately the problem, is that I think they're gonna have to reckon with the fact that when it comes to digital money, they're the new kid on the block, and they have certain advantages, with regard to the fact that they own the denomination that everybody deals with. So they, might be able to use that, but so much of the system is offshore dollars anyway. The onshore dollar has become even more irrelevant. As they've raised interest rates, it's become less and less of a factor as to what's important. And then on top of that, now they want to introduce all sorts of new regulations to limit the ability of these regional banks to invest their dollars, which is only going to push even more money into the shadow system. That's the thing that they just fail to understand with all of this, is that every action you take to prevent money from doing what it wants to do,
be creative,
just pushes it to the places where it wants to do it. And that place is way outside your system where you have no say here.
And here's the kicker. What's so exciting about the 23 narrative I've been refining is that historically it's been going to Europe and shadow banks where you can leverage collateral to print dollar-denominated liabilities. The same thing in Europe and every bank occurs, just like with U.S. domestic banks. There's a balance sheet. It means there's a business. Borrow short, lend long. Overall balance sheet health. You need to be solvent as an organization. Otherwise, every country has bankruptcy rules and regulations. And that is just points directly at immutable smart contracts that deal with shadow banking. You will take $100 billion worth of whatever collateral you want. You're going to Europe. You're going to be working really hard to get your dollar liabilities to finance debt obligations or whatever, capital enterprise loans and attempts at productivity growth, whatever the liabilities will be used for. But these permissionless systems, there's no questions asked. You have collateral, you get dollars. Mm-hmm. So that's the directionality. And what have we seen thus far? We've seen whatever it was like 40, 50 billion dollars, I think USDC and Tether are at, or whatever the numbers are.
Yep.
But where were we in late 2019? And where will we be in 2025, 2027? I love directionality. Directionality continues. It persists. It has momentum. And that means everything.
Yep. And like you can even see this too recently. Like here, let me pull up my screen here. Or actually, I don't think I have. Jedi, can you add my screen to the mix here? Perfect. So here's USDT's market cap. So, you know,
$81.89 billion.
Yep. But look at the directionality of USDC. This is the exact thing we're talking about here. This is onshore dollars, offshore dollars.
So bear in mind, USDC technically is.
I mean, it is an offshore dollar, but it's like it's a more like locally regulated version of it, and it's. I recognize that it is still like a euro dollar at the end of the day, but I do find that interesting that the one that's more useful overseas, USDT, is the one that has, mooned in its as the liquidity came back. So like you can see, like liquidity started moving upwards in the offshore dollar system here, and now it's starting to tail off again a bit, and maybe this is a double top. I don't know.
I don't do TA on.
I will. I'll do TA on anything. No,
everyone gets so hung up on U.S. domestic policy and regulation. It means nothing. I feel. Where's the Jim Cramer button?
I do think that domestic policy is. Studying domestic policy is studying the distortions that are being put onto the market, and if you can study those, you can then make some reasonable estimates about like how those distortions are going to impact the future.
Sure, but it's marginal. U.S. domestic policy is marginal in the crypto markets.
Yeah, it really is. But like what it does too is it forces money, because the more they try to control the domestic money, all those dollars that get recycled just tend to like make their way back into the free lands of less regulatory scrutiny, where the money can do what it wants.
And what's the destination? we talked about, you're describing regulatory arbitrage.
Yeah,
Where
absolutely.
and we tend to think of countries. What is the market, the economic market that has the least regulatory burden? It's literally the crypto market. Stop
Yep.
looking to sovereigns, general public, for which country will be the destination considering regulatory arbitrage opportunity. That
Now,
destination is the crypto markets. All they have to do is let the market mature, and you're going to see just collateral being used to print currency units, being used to serve as literally real world dollar denominated debt obligations. All they have to do is link it all up, and it's the ultimate regulatory arbitrage destination.
yeah, absolutely. Absolutely. And there's no one better positioned in my mind than ETH to absorb all that. Like,
And the
no one.
liquid derivatives, it's remarkable.
It really is. It really is. There's like, obviously DeFi has its problems. It's got its Ponzi's, and it requires a level of sophistication in order to sniff out which are the novel primitives that are actually going to be utilized by the financial system in the future and which ones are just a dog coin. But like, yeah, I mean, it's only a matter of time before everyone catches on. Like, I hate when I see this like narrative in like the TradFi, Twitter or whatever, where it's like, oh, DeFi is just, or like crypto is only speculation. I mean, it's like, yes, it sort of is, but at the same time, like they also say like there's no fundamentals to anything in crypto. And I say that's bullshit. Like there absolutely is. If you can't recognize the fundamentals in this space, you don't actually understand the space, because there 100% are tools that exist in this world, in this crypto world, that absolutely destroy their TradFi counterparts in usefulness. Like, I mean, just the fact that ETH right now, ETH and BTC have been performing very nicely while banks are failing. Why is that? No counterparty risk. Like, just having an instrument that is not gold, a digitally native instrument with no counterparty risk, sign me up. Like, seriously. Like, there's no reason not to be excited about that in and of itself.
We have a degree of go.
Isn't that the reason why they're leaning heavy against it? Because it really does mess with all of the above.
Well, they were sitting pretty because there was no alternative to what they had to offer. And now there's an alternative, and they're scared because it's being built out by intelligent people from all around the world. And the traditional, I mean, look at Swift. I mean, they just recently released FedNow. Swift was built in the 70s. Like, that's why they couldn't clear checks like without like a, several day waiting period, was because it had to run through the Swift system that like just was ancient in technological terms. And so
I think Swift's one of the biggest scams that has ever been and will ever be. It's like, it's just fucking like, yeah.
The centralization that of power that Swift allowed, and just the US dollar system in general being centralized the way it is, it allowed a massive centralization of power to take place. And over time, that centralization has gotten more and more stark as more and more regulations push the amount of control into smaller or fewer and fewer hands. Like the amount of power that like Jamie Dimon wields every day. But for those that don't know, Jamie Dimon is the JP Morgan CEO. But like that man, like wields incredible clout. Like the government literally came to him when FRB failed and was like, tell you what, we're going to give you a great deal. We will socialize all the losses here. You take a few billion, just take this off our hands so we don't have to call it a bailout. And because otherwise they were going to have to step in and bail it out because their buddies had a bunch of money in unsecured deposits there. So, well, that, and it's just the entire system is super interconnected. And like, I honestly wonder if they recognize, because I certainly recognize it, but like, I don't know if they recognize the interconnectedness that fails all these banks like fucking dominoes every single time anything goes even slightly awry. It doesn't happen in the crypto world because because the stable coin, you have stable coins. Each stable coin is its own bank. And if one of those banks does something stupid, anyone who is holding that coin gets wrecked. And so people do their due diligence about which coins they're going to hold. Some do, some just get wrecked. But like it punishes you for not doing your due diligence about what stable coin you're holding. And what that does is it forces those that like, you get this sort of like Darwinian mechanism of like, oh, hey, if I'm running a stable coin, I better be very secure in the way I manage my risk, because if I don't, everybody who holds this thing is going to take a giant haircut, and then all that collateral is going to leave and it's going to go elsewhere. So it actually reinforces security and risk. Like it has good, it doesn't have the moral hazard that a system where $1 at JP Morgan has to equal $1 at FRB, has to equal $1 at AIG, has to equal $1 at Bear Stearns. And if you don't have that mandate that $1 trades at par everywhere, no matter what, no matter how fucking reckless the bankers have been with their underlying collateral, then it actually get rid of the fucking FDIC and just let these things go to fucking zero. And that would actually fix the system. But the problem is we want this safety and security. So we just build in, this was bad and it wrecked a few people that didn't deserve it. And so we're going to protect people and protect and protect. And then what happens is over time, you just get this buildup of like a system that has reinforced moral hazard over and over and over again, because these banks, they know, hey, it doesn't matter, no matter what, the Fed's going to bail them out. Like, this bank's too big to fail. I'll just put all my money here. It'll be fine. And it doesn't matter how much inside dealing or how many mortgages that were irresponsible, interest-only mortgages they gave to startup CEOs. It doesn't matter.
We're past the point of no return.
We are.
I try my best to create narratives that are comforting and that are simple. It's the same way I do my day job as a software developer. In 2008, it was a catastrophe. It took a lot of time to come to the point where they threw moral hazard to the wind and they intervened. And fast forward 15 years, they do it on a weekend. It's done. The directionality is set. The status quo is what we just experienced this past weekend. And everything that Raul talks about is on point with regard to directionality. It's not about where we were, it's about where we are and where we're heading. How does the government structure and manage this system to continue, just to continue to exist? And then that's why his narrative I find refreshing, because it's very reductionist. It's for it to continue, for them to do what they just did on Sunday night at like 10 p.m. or whenever the hell they did it. The Fed just has to print the difference between GDP and fiscal expenditures. And that tells us the next that tells us forecast everything.
I mean, they already are to some extent, because like the way the Fed has been working. So like all this RRP money, right? That's paid for by the Fed. That's paid for by the Fed has to put up that for.
What is the RRP money?
The RRP finances short end of the bond market depreciation.
Okay. All right.
It prevents.
So it's basically dollar staking. It's a reverse repo facility. It's dollar staking that they use to try to keep dollars off the market that you would otherwise invest in U.S. Treasuries.
And the banks need to, by regulation, purchase the short end of the curve. So what the Fed is doing is they're paying the banks to not drive rates on the short end of the curve to basically zero, given the amount of dollar deposits that are in the banking system, considering regulation.
And just like a crypto protocol that does single-sided staking to reward people to lock up their money instead of spending it on something, or lock up their tokens instead of spending it on something, that money comes with depreciation. And so normally the Fed is actually profitable, like at least for the last, for the longest time,
ever.
The Fed has been a profitable bank because they have, infinite duration ability. They don't have like
max.
Yeah, they can take all the duration risk they want because they're the Fed. They can just leave something on their balance sheet forever. And if they need money, they just print money. So in the short term, well, they may keep that duration risk. And so like what's happening here is that the Fed is now, because of all the bonds that they bought at the Pico bottom or Pico top, I guess, price wise, and then raised rates using the RRP to pull the market up, they had to pay money to basically get those rates as high as they did by way of offering greater and greater staking rewards. And so what's happening is like they're not profitable anymore because they used to send money like every quarter, I think it was, to the treasury, like to the tunes of billions of dollars. They would send money back to the treasury that they had in excess of what they spend on operations. And so they're not profitable anymore. So they're not sending money back. And because they're not sending money back, there's a question of how you even account for that money, because it's basically a loss. So what they've been doing is they've been like counting it against future money they plan to send as an accounting tool. But like, it's basically just like a little spot on the balance sheet where they go, I owe you, $50 billion. And then the treasury doesn't see anything. So that's basically debt that's being monetized by the Fed.
Yes. Horribly financed.
Yeah. And it's money they're spending today in order to, they're spending like dollars today and they're taking on debts for tomorrow. So it's basically QE.
Listen, every country that has ever entered hyperinflation, we're doing the same thing, except the dollar won't hyperinflate because of the amount of global debt servicing obligations. So that's the path. The path is set. They have to print. The Fed will print, which was basically them purchasing the assets to do what they do with the bond market, to stabilize it, to liquidity. That's why Yellen always says they're worried about the liquidity of the bond market, because the bond market's everything. It's the collateral that is the currency creation engine of the world. Now, where did my screen go? I got to find my screen. I'll be right back.
You're still here. I promise.
Oh my God.
I do that all the time. I've got a number of screens and I'll end up losing what's going on.
Yep.
So just I want to just quickly come to the present in terms of like what's expected to play out today is like, 0.25%. on the interest rate. Everyone's saying no, don't do it. I mean, what is the outcome if they don't? I mean, isn't it just
It's
isn't
the
it a
same as if
double-edged
they
sword?
do. It's the same as if they do,
Yeah,
because
okay.
at this point, the extra quarter point means very little. What actually matters is how long they hold it there.
Yep.
Because how long is it before they have taken enough pain and they recognize the damage that's been done, and then they drop rates in order to protect from catastrophe? Because like at this point, there does not seem to be widespread understanding among the Fed officials that they are actively damaging credit markets. Like, because right now, to this point, it's all been like liquidity issues, right? Like you have all these banks that had all these securities that were socked away in this hold to maturity bucket. And this hold to maturity bucket, basically, all it does is it's a way of like them not having to mark these things to market and to take the losses that on paper they have, but they haven't sold them yet. And so they don't actually have to take those losses.
Wait, why did First Republic go under with considering the BTFP?
They didn't have enough of those assets, actually. First Republic was different, actually.
Oh, they didn't even have enough
SVB.
collateral to borrow at face value?
No, that's why they were mostly borrowing from the discount window, because they were actually using actual loans at the discount window rather than the BTFP.
Wow, they were insolvent.
Yeah.
Like not even HTM, BTFP insolvent. Okay, fine. Maybe they fucked up a little bit.
Correct. Yeah, they probably did. But but the point is that, like, where was I even going with this? I don't remember.
Where are we today?
Oh yeah, so I know where we were. So like all we've seen is like liquidity issues, right? These are liquidity issues. These banks, they lost all their liquidity. It all ran off to money market funds overseas. These were liquidity issues. But what we're starting to see in like the commercial real estate space and in like some of these holders of more illiquid assets, they're clamping down on credit. And you're seeing this like just yesterday, it came out that like the DTCC, the people that do like the tri-party repo clearing, they're no longer offering any sort of repo on as to use bank stocks as collateral on repo. And then today, BNB Paribas came out and was like, yeah, we're not buying anything with bank in the name. And
well, there's your credit markets, there's everything. And then that bleeds over into the banks, and that bleeds over into net 30, net 90 on small business. And I mean, isn't a credit crisis baked in, which means small business?
It's coming. It's coming. And the question is, how long do they keep rates here before it gets here to the point where they go, oh, this is on us. We gotta lower the rates. And I don't know how long that's going to take, but it's coming and it's going to be ugly as hell.
They if they were smart, like they do the opposite. They should be like cut 200 basis points, 300 basis points now, and it takes months, and that's the whole. It takes like 18 months for
and variable legs.
They don't understand physics and resonance. The only way to account for these deflationary pressures and the contraction in a bank's interest in even lending, the sentiment, the psychology of it, yet alone the balance sheet of it, is they need to front run the pressure. Yeah. Resonance, the physics concept. If you want to counteract the physical notion of resonance, you need to act in the opposite direction of the resonant direction. You need to apply not an equal and opposite, but you need to apply forces in the opposing direction. They're a quarter point raise in the resonant direction. They've never taken a physics class in college whatsoever.
No, I mean, they're all just a bunch of bureaucrats and like the thing, there's too many too many economics PhDs at that place. Like, not that they even really listen to them, like, but like the Fed is made up of a bunch of like hundreds of economics PhDs that all went to school for economic modeling. And that's all they know is just how to like pretend that the US is like this island of dollars. And then they just operate the system like it's a model where you can just ignore all that stuff overseas and that's all just like an error that function that we'll just kind of, ignore. And they're missing the forest for the trees. Like this whole system is that outside part. And that's what actually matters. That's what keeps a floor underneath the dollar. Like this whole notion that people think that the dollar is just going to plummet to zero is just insane to me. Or like this notion that the dollar isn't backed. Do you have a mortgage? Because it's backed by your house.
And
like
productivity.
You're gonna if the dollar literally goes to zero, you're gonna be there buying dollars so you can pay off your mortgage, right? So like it's backed by your house because like the bank just goes, oh, okay, I got this house. That's an asset. I've got this I have, they're balancing their liabilities and their assets. And to them, like those things balance out. And so they just raised their balance sheet and then they made dollars and they backed it with your house. And that's the collateral. And they'll sell it off if you stop paying. So it's just like a CDP. I mean, it doesn't work any differently.
So where are we? Balaji's right. He burned $1 million to tell everyone they're going to print trillions. And I don't subscribe in almost all regards to Bitcoin as a solution to money. But he's right. And he has his desire to focus on the properties, the significance of Bitcoin. And that brings us to a lot of what folks think about is how do we assess where we are, where we're heading, and what do we do about it? And, that's what we do. That's what I do, especially, is I like to give people a capacity to peer through all this bullshit and make rational choices about what you can do. And it's not what you should do. Is there's options, and there's Bitcoin, but that's not the entire story that everyone talks about. There's other considerations, and I wish folks were able to find the comfort that can be found by understanding the conditions. It's like what Michael Gaia talks about: conditions dictate path. And everything we just talked about for the entire start of the stream is the current conditions. And when you understand the conditions, you can find comfort to get a sense of probably where the path is going. Catastrophic credit event, small businesses are just like, get their net 30, net 90. They can't literally finance employees, period, because banks don't have any capacity to extend credit to them. There goes the employment numbers, and it's the same cycle over and over again. And then it really leads to what Raul talks about, and the Fed's going to absorb all of this illiquidity. They'll finance the liquidity needs to maintain the status quo, which is someone waking up and going to work.
Yeah.
And
basically, this is the Matrix, right? I mean, this is exactly what the Matrix is professing to be in this movie that was made almost 20 years ago. It's actually been more than 20 years ago. It's just that
the red pill.
You've been speaking about it a lot. You've been quite like almost damning, and I mean it could be construed as like it's doom and gloom, and you have been a bit of a doomer the last month or two, Captain Rational. And you said it as well. You said something along the lines of like, this is the recipe. Well, this is the way I interpret it, is that there is a recipe in place here for complete and utter disaster, but they simply won't let it happen.
They can, then you have post-apocalyptic scenario. Then you have
That's what you described, a post-apocalyptic scenario, which will never happen because they won't allow it. My question is, can the system reach a point where the bamboo snaps and no amount of support will actually be able to prevent it from cascading to this kind of like real fundamental doom and gloom scenario?
I think that at a certain point, like, something has to give. Like, they can either print the money to fill the hole and stave off the damage one last time, or I don't know how many more times they can pull this off, but I'm not even
But why
saying
not? Why
the
not? Why not
thing,
just keep on doing it? Why not just keep on
well,
doing
because
it?
every single time the problem gets bigger.
Okay.
At no point does anything they're doing actually fix anything. All it does is make things worse, but it kicks the can down the road. And
that's
so
what Raul talks about.
it's going to blow up in a way that they can't fix at some point. And then the question becomes, who do you save? The people with pitchforks at your front door, or do you save the elites? And I'm not sure.
There's two things that I say.
Where they're going to land on that.
No, it's a hard choice, but there's two things, and you got to reduce that. It's not what's more important isn't about who they save, because that's subjective. You don't know what the hell humans are going to do, and whatever. It'll drive you nuts trying to think about it and trying to assess what someone's going to choose. What's pertinent? They will have to finance social stability, because a country in chaos where you don't have a job to go to in the morning, people get crazy and they will do irrational things. So they will finance people remaining sane, and they will finance supermarkets to have food, because if a person goes to a supermarket and they can't buy food, they're going to shoot someone. So they will finance social stability. So this is the directionality, and there's only one way out, and that's what Raul's been talking about recently. They need to probably finance productivity, and they failed to do that for the last 41 years. With the debt growth, the GDP hasn't gone anywhere, inflation adjusted. So if they do that, that's what Raul talks about as the only path to exit this cyclical doom loop that they don't understand resonance, and you're just going to keep happening, and it's going to get more resonant over time, and it's going to get bigger and bigger. Or they finally finance productivity, which probably, and that's an interesting direction. That means they're literally going to be, the government will employ people to build mines, to build manufacturing, and they print it. But if you have mines and manufacturing, you have new products, new services, new GDP, and you don't have necessarily the inflation, so they'll have to deal with that. But you have more products, you have more supply, so they're able to suppress inflation by increasing supply. So what it leads to is more social narratives where the government is trying to control these financial pressures. They need to finance GDP, which they haven't done in 41 years.
Yep. I mean, I think so. There's a George Carlin hardcore history episode called Logical Insanity. And it was about like the US and like the decisions that went into that sort of led to us dropping the atomic bomb on Japan. And it, like, there was something that always stuck with me about that episode, because he talks about how if you just drop yourself right at the decision where they said, yes, we're going to drop this bomb, it seems insane. It seems truly insane to make that decision in that moment. But he talks about how in order to truly understand that decision, you had to understand the decisions that led up to that decision. And you have, and I think the same thing is happening here. Like, you had a bunch of banks fail, and then you know, the FDIC was created to try to prevent people from being hurt by that. And then there's all these little tiny decisions. Oh, Lehman Brothers fails. Oh my gosh, the banking system is in ruins. You know, we've got to bail out the banking system or the entire, you know, financial system is going to collapse. And then like each of these individual decisions, we took the easier path of the two. And eventually that is going to lead us to a truly insane outcome. And there's nothing that can be done to really stop it, short of just choosing when we're going to finally just take our lumps, or things are just going to get so out of hand that, you know, it ends in a truly catastrophic way. And like, I think that there's really only like so many bullets left in this gun. Like the Fed can, I mean, and I think that people do sort of underestimate though the amount of bullets in this gun. Because there's all sorts of things like debt jubilees and like all sorts of tools like where you can just sort of wipe out certain parts of the debt and move things around and restructure, consolidate banks, nationalize banks. You can like, there's a lot of different like governmental levers that can be pulled. You can go Bank of Japan style, and then you just like slowly take over the market till it just completely doesn't even exist in the private sector anymore. Like there are a lot of tools that they can use to suppress this volatility, but eventually it's all going to lead to a big vol event.
That's
Like,
short term. That's not even long term, but it's a cyclical vol event. And then there's the secular vol event, I would argue, is probably what you're thinking is like, you know, from 71 to now, 50 years later, that would be like something like fourth turning type stuff, which I don't think we're near that. And that's like what Brent would talk about is like, it's going to take 10, 20 years of continued increasing degree of intervention, and they're going to pull every trick in the book, and they're going to finance social stability, finance GDP, and it may have war, and that always works. And but the regime, the secular volatility event, where you literally have a collapse of social order, I don't think we're there. I think they just have there's so much room to go with interventionism. You know, we're talking like decades, 10, 20 years. Anything could blow up and they could finance it. Look at no other country wants to go through this. So they need their collateral, they need to print their dollars. So this regime is so going to continue for a good part of our entire lives. What, a fifth of our life, 100-year life, 20 years? So that's
yeah.
Comfort comes from understanding conditions and understanding time horizons, what's coming in the short term. And time horizons aren't the damn minute chart. They're not the hourly, the daily. They're not the weekly. They're not the monthly. They're the 6 month. They're the 1 year chart. What's coming next year? What's coming in 5, 10, and 15? Those are longer term time horizons. You could. It's like the 5-year plan everyone talks about when you're getting out of college. What's your damn plan? Now, most people don't consider this, but you have a 5-year, 10-year, 15-year plan. And you can't prepare for the 10, 15-year plan unless you're a doom prepper, which I'm not. But you can't prepare for the 5-year plan, and the 5-year plan looks pretty interesting.
Yeah.
So there's your optimism, Jedi.
I mean, that's the thing is, it's not necessarily the optimism side of it for me. It's like, it's understanding. It's what you said, right? It's like understanding what the conditions are and what the environment is and what the moving parts are allows you to then make what you would hope to be the best possible decision around the way that you navigate whatever it might be. And I think it comes down to, it's the fundamentals of life, is that make sure that you're making more correct decisions than you are making bad ones. Bad ones are when, you go and buy something that you can't afford and you can't pay it off. Bad ones are opening a trade when you should never have gotten involved. Bad ones are just bad decisions that make life harder. So what are we trying to do here? Why do I do this with you guys? Because I don't know, especially from a US perspective. I live in South Africa. I mean, what do I know about US economics and politics? But the US is the empire. The US is the empire that dictates the kind of like domino effect that the rest of the world is going to experience. And it was what you were saying earlier on, Ben, is that it's insane that these guys sit and they operate these things and they don't take into consideration like what's going on overseas and what's going on in Europe and what's going on in Asia. Like this is significant billions of people that are participating in this process, in these conditions, yet these guys are not considering that. They're just considering this game that they're trying to play without even having full context of what the game is.
And I think that's why crypto is so offensive to them.
Yes,
because
definitely.
It's the system outside their view that's been there all along, but it's all on chain and they can actually see it. And they go, what the hell is all this? Like, this shouldn't be happening. And they see that and it scares them. They're like, wait, what is this? Like we're foreclosing on banks and this thing's going up. What? Like they want to choke off the system, but they were never able to choke off the Eurodollar system. And honestly, they rely on the Eurodollar system. Like they don't realize, because there is, I think, a faction within the Fed and within the government that is like, look at all these people outside the US that aren't, under our control doing things that we don't control. But that's what makes the dollar so damn useful, is that it's a useful denomination that somebody that's making t-shirts in South Africa can do a deal with a textile manufacturer in India, and they can do that deal in dollars, and they don't have to ask the US government for permission to do that. They just say, hey, I'll give you this, you give me that, we'll trade this many dollars.
You know what's really interesting about what you bring up now, Ben, and that is that like my first exposure with crypto was through the gaming industry, and the gaming industry where we were selling virtual commodities, World of Warcraft, EVE Online, EverQuest, all those games. How do you think we transacted, dude? We transacted on the blockchain. I was getting value for what I was doing in World of Warcraft with somebody in India, in China, in Japan, in even Australia, where we didn't have to rely on banks to transact. Dude, this was like 2014, 2015. We were trading and we were exchanging Bitcoin, and it was kind of like, so that was my exposure to crypto. Is it was out of necessity because I was in a country that didn't allow that because of exchange controls and the rest of it. So I was forced to use that system in order to be able to transact and run my business.
And you did that because the government had basically carved out what they considered the legitimate economy from the illegitimate economy. And so by doing so, they created this so-called black market of
what the irony of it was, dude? You know what the irony of this whole thing was? I still paid my taxes on that. Because I still had to declare the flow of capital coming in and out of the country. I still paid my taxes, even though there was no facility in place for me to do that outside of crypto. Take that and put that in your pipe and smoke it.
I mean, at the end of the day, like at least in the US, I mean, the IRS doesn't care how you got the money. You could say dealing meth.
Yes.
And as long as you pay the IRS, they're not going to tell on you. They're not going to
They require you to report your drug dealing income as well as property theft as income.
Yes, absolutely.
So the system, this regulation, this desire to bring things into the regulatory regime, come in and register, will turn the crypto space into something larger than most can imagine. The second collateral is needed. I mean, it's permissionless collateral as well. You just buy your Ethereum and then you can create dollar-denominated currency units. What happens if all of a sudden $50 billion goes into Ethereum and someone then just puts all this buy pressure on USDC on Curve? What does Circle do? They got to arb the shit out of the LPs, and they're like, whoa, and now investors we got to print USDC, and it's just going to explode. This is in 2, 3, 4, 5 years time. The amount of currency creation capacity that this space offers is going to make the entire history of the Eurodollar market seem like a firecracker. And what did the euro? Well, if you would just look at sovereign M2s, it's small. The Eurodollar market is much bigger. And imagine dwarfing the Eurodollar market. Imagine dwarfing whatever it is, several hundred trillion or 1, 2 quadrillion, 10 quadrillion, 20. The demand for the currency unit, the dollar, then everyone says like the U.S. should want that, because that's true. It entrenches the dollar into the minds and hearts of the global population, because now they have access to it, and that's the whole point of the reserve currency. You need to provide enough liquidity so everyone has access to it, and that entrenches it as the reserve currency. So the U.S. has acted against their best interest by restricting offshore dollars, and now there's a mechanism in place, permissionless, no underwriting, no balance sheet complexity, no risk management department, post collateral. Here's dollars. This is going to entrench the dollar. This is going to reassert
the dollar as a denomination. The dollar as a denomination.
But this is why the whole crypto space is so. That's what you were saying early on. Is that bring your collateral and let's party. Otherwise, don't come anywhere near me. And that's what the beauty of crypto is. You either have it or you don't.
It's lovely. The systems that will offer these currency liabilities are designed sadistically to protect themselves.
Sadistically,
you will be liquidated, not by a person. There's no going to court or a special arrangement to prevent liquidation. Mathematically, quantitatively, if your conditions are met for liquidation, you are liquidated. Whatever that block, that's the interval.
Yep. It gets flagged. Done. The liquidator sees it in the mempool, and you're wrecked.
The protocol protects itself. There is not a bank out there that has a capacity to do that, because you have to call James over in St. Louis and he's sleeping. So you have to wait 4 hours for him to wake up to get to the office to do whatever the hell he does, and someone's liquidated a day later.
Yeah, if that. I mean, like the way margin calls work and stuff, like there is a lot of settlement risk in just that entire process. I mean, just look at like what happened with all the GME stuff, where you had that, what is it, T-2 settlement risk, where the stock was becoming so volatile that the intermediaries refused to even take that risk anymore. It just got too big to where the volatility was so great, they could not afford to hold that thing on, to be like intrinsically short that asset or long that asset for 2 whole days, because it was just more than the risk management department would allow.
So you said comfort, conditions, getting the humans out of the equation, all of that underwriting, all of that risk management that you just described, Ben, I'm done with it. I'm done with it. So I am absolutely expecting financial catastrophe. I'm absolutely expecting remarkable, astounding, awe-inspiring interventionism. And I am remarkably comfortable owning the things that I own. So I am both doom and gloom, and also comfortably moisturized.
Yeah. I mean, in that world, like, you know, owning assets that don't have counterparty risk, that don't really
bearer instruments.
Yeah, bearer instruments. Things physical gold seems like a good one, not financial advice. ETH, things where they have an intrinsic value that's outside of the sphere of influence of the system that is going to strive to protect itself above all else.
The power, one of the greatest things I think that crypto has brought to us is proving beyond a shadow of a doubt that decentralization and the network within the context of the internet can be and will be autonomous and completely and utterly uncorruptible. We've proven that. And for me, that's just one of the coolest things about crypto.
Arbitrage.
And that is what I probably love about it the most, and why it always comes back. So if you had to ask me why would you identify yourself as a crypto maxi, it would be for that reason, and that reason primarily.
Corruption resistant. I don't know that I'd say uncorruptible, but it's certainly far more corruption resistant than the current system, because corruption is just part of that system. We have the chance to start over here, and it will take time for humans to corrupt things. It happens slowly. They will try. We have a tendency to try to ruin everything with given enough time. But, maybe 80 years from now, ETH will have some issues like the dollar system has post World War II. But, we'll see. But I think it's good for a good 80-year hold in the meantime. So,
yeah, but how about that tweet I did the other day where it was, that's why I'm not fond of saving money. The concept I am invalidating as something that's significant. You need liquidity to finance things, but that means cash flow to finance things. Saving money seems so wrong to me nowadays. It's like I work today and I want to save that work for tomorrow. I'm finding it more distasteful. This seems selfish.
I agree with that. I've thought about that a lot.
Me too.
It doesn't particularly work for me either. I think there's got to be a constant flow of the work translating into
more work.
Something more than just the saving. It's got to be way more fluid and way more essentially rewarding. And I'm not talking about material reward. I'm talking about, sure, you could argue that the fact that you're saving it does give you a sense of a peace of mind towards something that you can do later on, but that's later on. What about in the next hour, or what about in the next, impermanence and all that kind of stuff? We could rant about that for hours, but it's I also feel the same way. I haven't made sense of it yet. When I do, I'll let you know.
It's a hard thought experiment.
Absolutely. Gentlemen, we are an hour and 15 in. I think we've
covered it pretty well.
I think so. Just to close off, it doesn't really matter what happens today with the FOMC. It's just a soccer ball that's being kicked down the road, and it's just going to have to play out the way it's going to play out.
I think it's safe to say that more hikes coming after this are unlikely, I'd say, at this juncture. I think if they do hike today, maybe they already have. I don't remember what time.
No, it's in an hour.
Okay. Yeah.
It's in an hour.
If they do, this is probably the last one, I would say. But you never know. I mean, who knows?
So if he says, cool, this is the last one, we can obviously expect the markets to just go absolutely berserk one way up.
Until a credit event.
Well, here's the thing. Usually, I mean, and if they decide to cut rates at this meeting.
Oh my God.
Historically.
Wow. If they cut rates, bro, Bitcoin is going to 32K within hours.
I don't know that that's true, actually, because historically, risk assets do very poorly.
Really?
When the rates go down
Wow,
because
okay.
that means it incentivizes everybody to run to bonds because they're now appreciating instead of depreciating. And B, it also signals, wow, we're seeing some really scary stuff on the horizon.
Okay.
We need to, lower rates. So now I'm not saying like right now, Bitcoin and ETH seem to be somewhat decoupled from what's going on in the, space of equities and whatnot. So like, I'm not entirely sure as to what the reaction function would be.
I don't
but
think it will last. I think they
Bear in
are
mind,
long term very much correlated, and I don't think it's going to change in a hurry.
equities. Well, it's what Raul talks about. It's the multiple. The S&P is 97% correlated to global M2, and
Yep.
NASDAQ is a multiple of that, and the crypto markets is a multiple of that.
Correct.
Listen, there is no way to know how markets will respond to cutting rates. Why? Particularly, every time they've cut rates in the past cycles, it was in response to an absolute financial meltdown. If they cut rates 200 basis points by the end of the year without some sort of crisis in response to a crisis, I don't think it'll have the same effect it has had historically. Overall, my sentiment is not just uncharted territory, because there is past precedence to the degree, like Lynn Alden talks about. But I think we're look at the wrong things, and I think two people that have one person really has probably the best sense of where things are and why they're there, and that 97% correlation is on a whole nother level. So I would like to end thanking Japan and China for financing global stability and equity market prices for all of 2022, because that was not depreciation. We did not see 50, 60, and crisis. We did not see crisis. We saw an orderly, relatively bearish market because Japan alone propped up global M2. Japan alone. And China blew it through the roof. So M2, global M2 is arguably the most significant thing to assess the directionality of risk assets. And the S&P will be 1-to-1, and the NASDAQ will be a multiple, and crypto markets will be exponential.
So
and on
I don't
that
know.
note, and on
Yeah.
that note,
we'll just call it.
and on that
Alrighty.
note,
So until next time, everybody, don't be exit liquidity.
Well
Or
said.
find some exit liquidity. Get out. No, I'm just kidding. All right. Take it easy, everybody.
Very nice.
cheers, guys. Take it easy.